Welcome to The Explainer. Today, we're diving into something that's totally shaking up the world of finance, tokenized stocks. We're going to break down what they are, how they actually work, and why there's such a huge deal for investors everywhere. All right, let's jump right in.
So, let's start with this number, $420 million. As of June 2025, that's the market cap for tokenized stocks. This isn't some far-off futuristic idea, folks. This is happening right now, with some serious money behind it.
And we're not talking about slow, steady growth either. That $420 million figure, it represents a nearly 300% jump in just the first half of 2025 alone. That makes it the fastest growing category of what people call real-world assets, or RWAs, on the blockchain. I mean, that kind of explosive growth tells you a major shift is happening under our feet. So that begs the million-dollar question, right? How does a share of a company, say Tesla or Nvidia, go from a stuffy old brokerage account to a digital token that you can trade anytime, anywhere? Well, that's exactly what we're about to unpack. Okay, first things first, let's get a really clear definition. What in the world is a tokenized stock? The easiest way to think about it, it's like a digital twin for a real share. At its heart, it's a digital token that lives on a blockchain, and it represents a piece of ownership in a public company. It's built to perfectly track the price of the real-world stock. You can almost think of it as a digital claim check for an asset that's sitting in a vault in the traditional financial system. Now, this is super important to get. Not all tokenized stocks are created equal. You've got two main flavors. Over on the left, you have the fully backed kind. This is the real deal. It represents actual legal ownership because it's backed one-for-one by a real share held by a custodian. But on the right, you have synthetics. These just give you exposure to the price of the stock. They aren't backed by any shares, which means no dividends, no voting rights. It's the difference between actually owning it and just betting on its price. So let's get into the mechanics of it. How does a traditional stock make that incredible journey from Wall Street onto the blockchain? Let's pull back the curtain on this fascinating four-step process. But really, what this is all about is building a solid bridge. It's about connecting the trust and reliability of old-school finance with the incredible speed and flexibility of Web3. And here's exactly how it's done. All right, here we go, step by step. Step 1 is custody. A regulated company buys real shares and puts them in a secure, licensed vault. Step 2, creation. The platform then mints or creates the exact same number of digital tokens on the blockchain. Step 3 is trading. Now investors can buy and sell these tokens on a marketplace, often 24/7. And finally, step 4, redemption. Some platforms even allow you to swap your digital token back for the actual original share. Pretty cool, right? Okay, so we know the how, but the really big question is, why? What's the point? What problem is this technology actually solving? Well, this is what our source material calls the tokenization edge. I mean, just look at the difference here. The old way, if you wanted to buy US stocks from another country, you were stuck with geographic limits. You could only trade when the market was open, and you had to deal with messy currency conversions. Tokenization just blows all that up. It gives you global access, 24/7 trading, you can buy tiny fractions of a share, and you can trade directly with stablecoins. It's all about tearing down the old walls. So when you add all that up, what do you get? You get a system for investing that's more open, more fair, and just plain more efficient. Tokenization is basically leveling the playing field, and it's opening up these huge markets to millions of people who were totally locked out before. Of course, anytime you're mixing big money with new technology, you have to talk about the rules, regulation. But this isn't about slowing things down. It's about building a safe, secure bridge between the world of crypto and traditional finance. And in major markets like the United States, the logic is pretty simple. If it looks like a security and it acts like a security, well, then it's going to be regulated as a security. The big challenge has always been, how do you actually enforce those rules on a global, decentralized blockchain? And that really brings us to the holy grail here. The source we're looking at puts it perfectly. The whole goal is to combine the reliability of traditional finance and the flexibility of Web3. So how do the legitimate regulated platforms actually pull this off? Well, the smart ones build compliance right into the technology itself. They bake in things like identity verification, they monitor transactions, and they only work with licensed custodians. They also get properly registered with regulators like the SEC or FINRA. Our source points to INX as a great example of a platform that was built from day one to meet all these standards, which creates a safe and totally transparent place to trade. Okay, we've covered a lot of ground here. We've talked about what tokenized stocks are, how they're made, why they're so powerful, and how they're being regulated. So what's the one big idea you should walk away with today?
You know, the potential here is just massive. What tokenization really offers is a way to democratize access to building wealth, to break down the geographic and financial walls that have defined markets for a century. And that leaves us with one really powerful question to think about. Could this be the technology that finally builds a bridge connecting every single investor to every single market on the planet?